welcome along, everyone. Thanks for taking some time out of your what is undoubtedly a busy day to join me here to talk through what's going on at Squirrel for our investors. Let's get into it. So today's agenda, we've got about 20 to 25 minutes of presentation material that yours truly will take you through. So we'll look at how the housing market's going, how the Squirrel lending portfolio is going, and there's some platform improvements that we've made over the last few months here at Squirrel. Of course, one of the most valuable parts of the session is Q&A. You can ask me anything about Squirrel or about the topics that we cover during the course of the day, and you can simply pop a question into the chat box on your Zoom screen. Feel free to put questions in as we go. You don't need to wait till the end. If I see some questions pop through, I may answer them on the way through, or I might hold them off till the end. We'll just see how we go. And last but not least, we're recording the webinar today, and we'll email a link next week. There's actually a second webinar on tonight, so we'll mash the two together, take the best bits and the best questions and things, and add them together. So you'll see a link for that next week. Rightio. Housing market performance. Let's start there, shall we? Lots of headlines around in the media at the moment. What do we know so far? We know that prices peaked in October 2021. So we're about over 12 months past that peak. If you believe any of the economists in the Reserve Bank, expectations that prices are going to fall around about 20% from peak to trough nationally. We know Wellington is already down almost 20%, getting close to that. Auckland's off about 15%, but there's also some smaller centres that are off about 5%. So you've got quite a bit of variety going on in different parts of the country. Turnover has dropped quite a long way. So the volume of houses selling from the frantic times of last year were down about 30% from what we had been seeing. And we're back to kind of around about 2018, 2019 levels, maybe a little bit under that now. Last but not least, I think housing supply demand is actually reaching a balance point, which has been a long time when we just have not had enough houses in New Zealand. We've seen a number of Kiwis head offshore in recent times, which obviously reduces demand. And there hasn't, up until now, been a lot of people coming in to replace them. When you couple that with record numbers of houses being completed this half of the year and into early next year, actually we're finally starting to see some catch up, which I think is a healthy thing for New Zealand. So who's buying? What we've seen is first home buyers have, while the numbers are off relative to the last couple of years, they're making up a bigger proportion of the market. So the 21% of all properties are being sold to first-time buyers at the moment, which is pretty high in the scheme of things. Quite a notable drop from the number of properties selling to property investors. If you look at the grey bars or grey parts to the bars in that chart, you'll see that relative to August to October 2019, they've dropped in settlement volumes from 3.3 billion during that period to 2.6 billion. So it's quite a notable drop there. And clearly owner-occupiers have pulled on the reins, they're slowing things down, they're not making those decisions. And we're starting to see a bit of that come through in our own loan book, where we're seeing less people wanting to come along, get a personal loan for renovations and those sorts of things. So I think generally we're seeing the very first signs of people saying, inflation's pretty high. And interest rates are only headed one way at the moment. So actually, maybe we won't spend, which will be music to the Reserve Bank governor's ears if anyone followed the monetary policy statement that was made last week. This data here is from Centrix. So they publish market data on a monthly basis. And this was just published yesterday. So I've just, from their monthly report, I've pulled out a couple of graphs that I thought were pertinent for this discussion today. So arrears on home loans still remain at what is an incredibly low level, but I think we're starting to see the very first signs of them starting to tick up a little bit. You can see in the graph on the right, consumer loan arrears. So personal loans is the blue line and grey line is loans for vehicles. So both of them have had lows in over the last year or so, but are starting to look like they're trending upwards. So I think signs of a bit of stress starting to emerge in the market. My pick would be that some retailers will probably do it a little tougher this year than what they might have been expecting, despite the fact that unemployment rates are still incredibly low. So moving on to a bit more about how the Squirrel loan book is performing. So I've popped our 3 investment classes in that table. So home loans, construction loans, and personal loans. And then some of the data that we look at on a day-to-day basis around how those loans are performing. So if we look at home loans, no loans that are in arrears, and we count arrears as 30 days plus, which is how arrears are typically measured in the market. We've got 1 loan that's over term, no particular concerns on that one. We've never had a default for our home loans, and there are no home loans in hardship at present. For our construction loans, we've got 1 that's in arrears, so it's over 30 days in arrears. We're keeping a pretty close eye and talking regularly with that borrower. We've got 5 over term, which is probably the standout number, I think, in this whole table. 3 of those are related to loans where a house is being built or a couple of townhouses being built. Those loans are expected to complete during December. So you'll see that number come down during the course of December. And we've reported, between 2 and 3 loans that are over term in each of the last 5 or 6 months. And what we're simply seeing there is loans running over by anything from 2 to 8 weeks as projects finish. So supply constraints that you've seen in the market, coupled with slow getting through council consents. If you remember before, I said that there was a record number of houses being built. So that puts a lot of stress on councils, just sheer volume of consents that they need to get through. We've not had a loan default for our construction loans in our life to date. So we started our lending for home loans and construction loans in March 2019. So we'll be 4 years in March. So yeah, we're starting to get well down the path now. Hardship doesn't apply for construction loans because they're for business purposes. In personal loans, so personal loans have been running for just over 7 years now. Our arrears rate is 2.6%. If you remember back to the chart on the previous page, arrears in the market are running at about 8%. So I would suggest that our personal loan portfolio is in pretty good health. We've got a small number that are over term. Our lifetime default rate's 1.1% and falling. I think at its peak that got to about 1.4%, but based on the fact we've dialed back our risk appetite for personal loans progressively over the last 3 to 4 years, I would expect to see that default rate starting or continuing to fall from where it is today. And last but not least, we've got 2 loans that are in hardship. So home loans, no particular concerns. Construction loans, we're just keeping a close eye on the one that's in arrears and those that are over term, but nothing untoward in those at this point. And last but not least, our personal loan portfolio is in very good health, and reserve fund is looking great. Speaking of reserve funds, so this particular chart we publish on the website, and it's updated, would you believe, on an hourly basis for most of the stats that you see here. I took this snapshot about lunchtime yesterday. So what do we know? Reserve Bank is expecting a recession. The depth of that recession is up to anyone's judgment to take a stab at. The unemployment rate is probably the main thing that I keep an eye on for our home and personal loans. The unemployment rate's probably a key to that. You look at all sorts of different economic indicators, but ultimately, if you've borrowed to support your house in some way, shape, or form, it's often your biggest asset. It's the thing you're most going to pay, and really, it's unemployment or not having an income coming in the door that's going to be your biggest issue. So at the moment, unemployment rate's at 3.3%. It's about as low as it's ever been. RBNZ's forecast from their monetary policy statement was that we'd see the unemployment rate get to in the high 5s somewhere. Based on modelling that we've done at different times, I don't see any particular issues with an unemployment rate that gets up to, say, 6%. At the beginning of the COVID lockdown, we modelled things right up to 10%. And Reserve Bank has more than doubled in size since that point. And the portfolio hasn't doubled in size. So I'm feeling pretty comfortable with where things are at there, even looking ahead to a potential recession. For construction loans, they're much more dependent on the state of the housing market. We started reserving more money for construction loans. You may recall that from earlier this year. That was around May, June that we made those decisions. And that reserve fund is building at over $40,000 a month at present. So that's in pretty good health. We are thinking about reserving a touch more to accommodate the growth that we've seen in the construction loan portfolio. So basically what happens as new investors come on and invest more money into construction loans, that portfolio grows really rapidly, but the reserves only grow as loans start contributing to them. So it's easy if you get a lot of growth for that reserve fund coverage ratio to start getting out of whack, which is the 1.15% you can see in that table. I want to make sure that it's over 1% and perhaps around sort of 1.5% over the next couple of years. So we may increase reserving a touch more to accommodate the growth that's going on in the portfolio. As I said, it's not in relation to the credit risk in the portfolio, and I'll cover that in a little bit more detail very shortly. If you have questions about any of the data that you see on that table, feel free to pop them into the chat. Okay, so credit risk, our appetite for credit risk and reserving. So what the graph here shows you is the amount of credit risk in the active loan portfolios for construction loans and for home loans going back to May 2021. So you can see that credit risk for construction loans is probably averaged around 60 or 0.60% or 60 basis points over the period that I've shown here. What we did though is we reduced our credit appetite. So we pulled back a bit. So we have a credit policy, which is in place and has been in place for a long time. And then we have a credit appetite that sits over the top. So as the market's going really well, we might increase our appetite a bit. As the market starts to look not quite so strong, we might reduce our appetite a bit. So in May this year, we reduced our appetite, which might mean, for example, that we will only take on loans with a slightly lower LVR. At that point, we also increased our reserving. Because construction loans roll on and off the books relatively quickly, you can start to see the traction we're already starting to see with taking on less risk in the portfolio. And we've seen, as at the end of October, 42 basis points of credit risk in the portfolio. Now, what does that 42 basis points actually mean? Key thing to look at there is how much risk we're taking relative to the amount that we're reserving. So we're currently reserving at 95 basis points, so a bit over double the amount of credit risk in the portfolio. So it's a healthy and we believe relatively conservative balance for the amount of risk that's there versus the amount of reserving that's going on in the portfolio. The orange line in that graph shows our home loans. So the amount of credit risk in that portfolio is running at 15 basis points, and it's hovered around that 10 basis points line over the time period. So a lower level of risk in that portfolio. Okay, moving on to some new Squirrel investor features. So you will have seen us move the minimum investment amount down to $100 from $500 earlier this year. That's been a really healthy thing. I had lots of really positive comments from investors post that change being made. When we did that, we also made a change to the way our auto invest works. What we've seen is a greater uptake from investors of using auto reinvest. And we've seen about 25% of our active investors are using auto reinvest now, which is great. So the way auto reinvest works is we monitor the amount of cash in your call account for you. And at the point at which you get more than $100, if you've turned on auto reinvest, we'll automatically place a new investment order for you for the investment class that you've set the auto reinvest up for. So that seems to be working really well for a good chunk of investors, and worth taking a look on our website at the detail that we've got around that. We've also improved the marketplace statistics that you can see when you log in via a browser. So when you log into the Squirrel investment platform, you'll see, and you go to place an order, you'll see the detail that's in that screenshot at the bottom of the page here. So I'll just talk through a couple of things that you can see there. So clearly for each of the 3 investment classes, you can see what the prevailing interest rates are. And then you've got the 4 arrows. So I'll start with the top arrow, which is what's the investment opportunity now? So I took this snapshot once again around lunchtime yesterday. At that point for home loans, there was 1.4, or we'll call it 1.5 million of investment opportunity. So if you placed an order, you're going to get matched to that straight away or within an hour. And if you scroll across there to construction loans, there was just under 700,000 available at that point. And then for personal loans in that 1 year space, there were no loans available at that point in time. For the second arrow, it looks at what's the upcoming investment opportunity. So for home loans and construction loans, we actually have a whole lot of loans in stock. So if I talk like a retailer for a second, we have these loans sitting on the shelf and we feed them into the market as there is investment demand. We try to make sure that we sell out a loan completely before we load the next one in. So sometimes if you go and look and there's only, for example, $20,000 left of construction loans, if you go to place the order, you should be able to see in this upcoming investment opportunity, that's how many loans we've got in stock. So for home loans, there was 1.4 million in stock. For construction loans, there was 16 million in stock. So never fear, if you've got 100 grand to place an order, you only see 20 grand on the market, place the order, we'll feed a new loan through and you'll be matched to that. Often when we have a loan mature, it chews through the loans that are available either through the secondary market or from Squirrel really quickly. And so, we try to keep a really close eye and make sure we feed a new loan in as soon as those numbers get down to 0. And for personal loans in the upcoming investment opportunity, you can see that says 85,000. So that's looking into our personal loan pipeline. So that loan won't have settled yet, but it's coming through the pipeline for settlement. So that's how to read that number. So it's not there today, but it's likely that it will settle sometime in the next week or 2. Third arrow down, recently funded in the last 7 days. So this is the volume of activity that's rolling through our marketplace over a 7-day period. So you can see there's 1.8 million of loans that have moved through the home loan market in the last 7 days, 8.6 million for construction loans, and just $1,420 for the 1 year personal loans. Note, you can change the filter to from 1 year to 2 to 3 years and to 5 to 7 years, and the data will update. So you can see if you're placing orders for personal loans, where things are at. Last but not least, the fourth arrow there, investment orders in the queue. So for home loans and construction loans, typically that doesn't mean much because there's always loans available. So you don't need to get too worried about that. For personal loans, though, often we have a supply-demand mismatch. So we have a lot more investors wanting personal loans than we have loans available. So you can see for the 1 year personal loans, there's $633,000 worth of investment orders that are in front of you if you were to place an order now. You should be able to look at how much is in front of you, what the upcoming investment opportunity is, and that'll help you decide whether you should place an order in that personal loan space or not. Remembering you can scroll through the different terms. So I think those marketplace stats are really helpful, and you can see those when you log in via the browser. You can see a slightly slimmed down version of that when you log in through the mobile app. Thanks for bearing with us while we've gone through and updated the design for our desktop users. Hopefully you're finding things more intuitive and easier to navigate as that new design is progressively rolled out over the last 3 to 4 months. Last but not least, we've also updated our website content. So if you haven't been to look at the website recently, I'd encourage you to go and take a look at the Save and Invest tab. You'll see lots of new information presented in a better way than what it was before. And there's some new marketplace statistics there looking at, for example, the secondary market and how the secondary market's going. So lots of information there. We try to be really transparent with what's going on. Righty-ho, nearly there. Last thing is a bit of a brag here, actually. The Squirrel Monthly Income Fund, we launched in October 2021. So we've just had our first birthday for the Squirrel Monthly Income Fund. Over that period, that 1 year period, it was actually the 7th best performer on the Invest Now platform, which is way higher than what I would have anticipated. However, when you look at the volatility of the equity markets, you look at what's happened in the bond markets, because interest rates have risen, the value of bonds has typically dropped. Then actually the little old Squirrel Monthly Income Fund's actually done really well. So all the investors through that fund have had a really stable capital outcome compared to the volatility that many other managed funds have gone through during that period. Over that 1 year period, we had a return of 5.4 investors. So if you're invested from day one, that's the return you would have received after fees and before tax. The running yield, so if I look at the return just for the month of October, the running yield equates to about 6.5% per annum. So as interest rates have risen, we have seen the yields rising, and you'll see that the returns on the fund continue to tick upwards over time. The Squirrel Monthly Income Fund, that invests like any other retail investor on our platform, and the fund takes a mix of home loans, construction loans, and personal loans. And you have the option of having your returns paid out on a monthly basis or capitalized back into the fund. So if you're not into being a really active investor, as you need to be a little bit if you're investing directly via our Squirrel Term Investments, then the monthly income fund might be something that you're interested in. I didn't mention, there's 157 different funds on the Invest Now platform. So to finish 7th, we thought was pretty damn good. It looks like the first question is there from John. How do you see rates tracking over the next 2 to 3 months? Okay, John, I'll answer that question in a few ways. One, for the market, what do I see interest rates doing in the market? And then I'll answer it for Squirrel. How's that? So first of all, if we start with the market, so we saw the Reserve Bank increase the OCR by 75 basis points last week. Interestingly, we've not seen any banks or financial institutions particularly respond to that change so far, but trust me, it's coming. Perhaps no one wants to go first. I suspect might be more of the issue. So I do strongly suspect that we're going to see floating interest rates head upwards on the mortgage side of banks' books, probably by 75 basis points, but we'll have to wait and see. Equally, I think you'll start to see term deposit rates increase a little bit. It would be fair to say the banks have got a lot of cash at the moment, so there's not necessarily a lot of pressure on them to try and raise funding or raise funds. So I think we'll see a bit of increase on term deposit rates in the market from the banks. In the fixed rate market for lending, over the next 6 to 9 months, I would say you're going to continue to see rates track upwards from where they are today. So they're around about 6% today for the kind of that 1 and 2 year space. I think you're going to see that 1 and 2 year space continue to track upwards. And if there's a few reasons for that, one of them is the Reserve Bank has a funding for lending program that started during the COVID period, which effectively gave the banks access to a lot of money, about $12 billion from memory, and the amount they were charged for that is the official cash rate. That money starts to roll off from next month. So over time, I'd expect as that pool of relatively cheap funding starts to dry up, I'd expect you to see a bit more pressure come on banks to increase their fixed home loan rates and equally increase their term deposit rates. What we have at the moment in the market is an inverted yield curve. So rates for 5 years are lower than they are for 1 to 2 years. If you look at a wholesale interest rate level. So the other interesting part there is basically the market saying interest rates are going to fall at some point over the next 2 or 3 years. And therefore, you're starting to see that yield curve fall for longer interest rates, but remain high and perhaps go higher over the next sort of 3, 6, 12 months until we start seeing inflation coming back. On the Squirrel front, I would expect you'll see an increase for our home loan and construction loan interest rates for investors and borrowers, and perhaps a small increase for personal loan rates. That's what I'd expect. I would say we'll probably make some decisions during the course of this week on that front. Hopefully that's answered your question, John. You might have got more than you bargained for with that one. All right. Next question from Rawiri. Looking at the second family property, but trying interest rates aren't kind or house prices. You see a fall in house prices within the next 3 months. So will house prices continue to fall? I would say probably a little bit. For Wellington and Auckland, for some other centres around New Zealand, maybe they'll fall a little further. And that's a whole combination of things going on. So there's less demand, so there's less buyers out in the market, which perhaps pulls prices down. You've also got interest rates rising, which means affordability can start becoming more of an issue, particularly for first-time buyers. And there's a lot of supply of new houses coming onto the market. So take all those three in combination, I suspect house prices will continue to fall a little bit from where they are today. It's highly unlikely they're going to fall another 20%, though, if you're looking to buy a new home. If that was where your question was targeted at. So hopefully that helps you there, Rawiri. Okay, next question from David. Looking at the general home loan market, do you see a significant number of borrowers finding their loans are no longer affordable once their fixed rate loans reset? At present, David, the question is no. And the reason for that is that banks, when they offer you a loan, have tested you at an interest rate that's well above what today's market rates are. So even when interest rates, people were picking fixed rates up for home loans in the 2s, banks were still testing you at 6.5% to 7%. I think it's about as low as the rates got. So what that means is actually if you were owning your own home with a mortgage, you probably had a fair amount of surplus cash relative to what the bank thinks you can afford to live on. Okay, so as interest rates have gone up, and interest rates today are around that 6-ish% for those fixed rates, you would find that they have that they should be able to afford their loan. That doesn't mean to say they won't need to tighten the belt. So that means when they're going grocery shopping, they might choose more budget brands than some of the premium brands. For just as an example, they might be shopping around a bit more for who their electricity and phone provider is. They've just got to find ways to tighten their belt. That gets harder with the way inflation is moving. And it can take a while for wage increases to flow through. Inflation's kind of immediate in some respects, but wages can take can be on a longer cycle for that to flow through. So right now today, are loans affordable? The answer is yes. Does that mean homeowners need to tighten their belts? Yes, it does. So, Christmas holidays might not be quite so flash this year. They might not spend quite so much on presents, those sorts of things. Homeowners, for the first time in a long time, probably need to tighten their belts more than they have for a long time, particularly if they've been in that market for a while. It's probably a small group of customers who bought right at the top of the cycle, who might be in a negative equity situation. So there's a relatively small group, and sometimes the media can blow the size of that group out of proportion. Typically, those people all have jobs. The job market up until today has still been incredibly strong. Who knows how that's going to flow out over the next 12 months. But while there's plenty of employment around, there's plenty of opportunities for people to either stay employed or look for that new job that pays them a little bit more to help with that belt tightening exercise. I know, there's my views, David. This is all opinion at this point, so hopefully that helped. Question from Lance: is the market for high quality construction loans competitive with other lenders? I think the answer is yes. So what we've seen in that construction loan side of the market, if you look back about 6 months, there was very little money around in the market for construction loans. And the reason was that it had all been lent out. There's so many houses that have been built in this half of 2022, more houses than we've ever built as a country before. And so all the development lenders were chock-a-block, and it was very hard to find funding in the market for them. There just wasn't any funding around. As those developments start to roll through and loans get paid back as the houses are subsequently sold, then there's a bit more cash coming back into the market. I think my observation would be what we're seeing is that there's funding out in the market, but only for high quality deals. So what's a high quality deal in that construction and development space? So lower LVR is good. Pre-sales is almost mandatory across most lenders. And a feasible project. The lenders are looking pretty hard at developers and checking their experience levels, knowing that we're going into a market that's going to continue to be tough over that next 12-month period, we'd expect. Is the market a bit tougher for construction lending? If it's a good quality loan, there's lots of lending available. If it's a bit harder loan, maybe not so much lending available. Thanks, Lance. All right. How do you evaluate house prices versus interest rates to make a good buy? Well, there's a $1 million decision on that one. Will interest rates stay really high for a long time? And when I say long time, years into the future? Probably not. I would say we're going to see fixed interest rates that might get up around 7%, let's say, give or take. So there could be another 100 points of tightening there in the fixed rates. How long are they going to last at that level? Well, the Reserve Bank in their monetary policy statement last week said the neutral official cash rate was probably sort of somewhere between 3 and 4%. Okay, so that means when you've got fixed rates at 7%, they're probably helping the Reserve Bank do their job of tightening the economy up, which means that they won't stay there forever. So if we do go into a recession, and let's assume that inflation is brought under control, then I'd expect interest rates would start to fall. So we've got higher interest rates for probably 12, 18 months. This is all opinion, of course. And then at that point, perhaps interest rates might start coming back a bit if the economy truly is underperforming and we've started to see inflation start to level out. Thanks, Rawari. Question from Spencer: is the reserve fund dollars invested outside or inside Squirrel? So all of that money that sits in the reserve funds sits in a bank account at BNZ, and that's quite deliberate. It does earn interest, so it's earning, today probably about 3.75%, give or take. And the interest that it earns just capitalizes back into the reserve fund. Why don't we go and invest that money is a question that I've had on occasion. And the answer is, well, at the time you most need that reserve fund dollars is the time that it might be hard to get money out of an investment. So we think the best thing to do with that money is to leave it in a bank account earning interest, because then we know it's always available. Now, obviously, we're subject to risk if BNZ happen to fall over or something like that, heaven forbid. However, we think the 4 major trading banks, you can look at the Reserve Bank stress tests on those, and all of them come through with flying colours. So it sits in a bank account. We don't invest it outside Squirrel. And while we may be sacrificing some return for that money that's in the reserve fund, we know that it's there, it's liquid, and it's available at the drop of a hat, which I think is pretty important, given the job of a reserve fund is to be there to make good on investors if borrowers go bad in some way. Thanks for that question, Spencer. If there's more to that one, feel free to ask another question. Okay, next question. Is Squirrel looking to open up any new categories of loans? If so, what are you thinking of and over what time period? On that front, we are really focused on the residential housing market. From a Squirrel perspective, that's the market that we know best. We've got a run rate of about $2.5 billion of residential house settlements annually, courtesy of our mortgage advisors. If you compare that to others in the market, let's say one of the major banks, and you look at the amount of loans that they settle themselves directly. So let's take ANZ, who is the very largest of the banks in the market. They settle about 45% of their loans directly through their branches and their mobiles and things like that, which equates to about $10 billion a year, $10 to $11 billion a year. And Squirrel's run rate's about $2.5 billion a year. So actually, we've got a fair, we know that market really, really well, and we're concentrating on that market. So while we might think about other categories over time, in the medium term, I wouldn't expect to see any other categories pop up. We might reshape what we do a little bit, but broadly speaking, I think we're pretty comfortable leaning into that homeowner space and that, the minor development space, so small loans in that development space. Thanks for that. Oh, sorry, one other thing there. I guess from time to time, we do have others in the market, other financiers in the market come to us and say, would you consider putting our loans on your market, on the Squirrel market? And our conclusion at this point is no. We're really confident in what we're writing. We're not sure we want to expose people that have come to Squirrel for Squirrel-based loans to loans that have been written by other lenders. So for now, every loan that we put on our platform is one that we've originated ourselves. We know the loan. We're comfortable, obviously, with the credit risk and what we've and the parameters that we've discussed with our investors. So that's where we're focused. Righty-ho. Great to see such an awesome list of questions here, because it makes things way more interesting than hearing me rabbit on about what I want to talk about. Next question is, we have a construction loan, auto reinvestment with Squirrel, but I'm not quite sure how to check the return on the investment over the past year. Probably the best thing to do is if you log in via the browser, there's a number of reporting functions there. So in the portfolio tab, it'll tell you what your current return is, which will be running at 6.75% per annum at present. And that's before tax, or before resident withholding tax is deducted. If you go to the reporting tab, then you can see your resident withholding tax statement and download that. So it'll show you what your return, or the total amount of interest that you've earned over that period is. So you can figure out from there relatively easily, based on how much you've got invested, as to what your actual return is, given that interest rates have moved somewhat during the course of this year. Thank you for that question. Next one from Catherine. What sectors do you think will contribute to the predicted increase in unemployment to 6%? Or to put it another way, what are the high-risk sectors first to feel impacts in a recession? Well, if you assume that consumers are a big driver of what happens in our economy, I think that's a reasonably safe assumption. Clearly, there's also business-to-business stuff going on and those sorts of things. But what are consumers likely to tighten their belts on? Are they likely to be buying new cars? Probably not, albeit the transition to hybrids and electric vehicles will probably see that segment stay up a little higher than what it may have in past cycles. Will they be spending lots on a new kitchen? Probably not. Will they be aiming to try and keep on top of their bills? They will, and it's those, the necessities. So, utility bills, phone bills, those sorts of things, they'll be aiming to keep on top of those. But that might mean if you're a movie theatre, you might see a little less demand. So entertainment type activity, hospitality type activity, as the unemployment rate starts to creep up, you may see that start to soften as people just have to find ways to tighten their belt. So I think if you think of yourself as a consumer and you thought about how you might tighten your belt, then the answer may well be those industries. There's probably some pain coming for some large-scale property developers, I would say. There'll be some developers sitting on a lot of stock, which then has a flow-on impact into the subcontractors, so the tradies that have been helping build those houses. What else? Yeah, those are probably good things. On the flip side, though, our dairy sector continues to perform really well. Relatively high milk payout ratios. While that might be starting to come off a little bit, that's still been really high over the last 12 months. Still plenty of demand for the food that we produce as a country. So our exports still are typically hanging in quite nicely. So pretty general question there, Catherine, but hopefully I've gone some way to answering that one for you. Follow-on question here from John. If Squirrel raises rates, will you send out a notification to investors? Absolutely. So when we move our interest rates, whether that's up or down, we send out an email and let you know that that's changed. We typically also have notifications on our platform, which tell you that interest rates have moved up and down. We have a 5-day notice period for both borrowers and investors, so everyone moves at the same time when we make those changes. Thanks, John. All right, next one from Patricia. Squirrel Income Fund invests across home, construction and personal loans. Does it have to wait in the same queue for personal loans as individual investors? Absolutely, the answer is yes. So the Squirrel Monthly Income Fund places investment orders just like any other investor does. We can't jump the queue. That wouldn't be ethical or fair. And I wouldn't be able to sleep straight in bed at night if we were doing anything other than waiting in the queue just like everyone else. So the fund sits on a bit of cash while it's waiting to get invested. And in the queue at the moment, we're typically investing in that 5 to 7 year part of the market. And we have, I don't know, maybe 100,000 worth of orders in that particular queue as it stands at the moment. Maybe a bit less than that. I think we might have got some invested yesterday. So that gives you a sense of what we've got sitting in that queue. Thanks, Patricia, and really good question. Obviously, we don't have to wait for home loans and construction loans because we always have a good supply of those available to our investors, including the managed fund. Righty-ho. Question from Irene. I normally invest in construction loans because they turn over in a shorter time than the home loans. I'm not sure how home loans work in terms of when they're repaid. If I invest in a home loan, can I close my investment before the loan is repaid? So with our home loans, typically most loans are written for somewhere between 6 months and 3 years. So on average, they are longer than the construction loans, which tend to be around 12 months in length, give or take. So with the home loans, they still do turn over. It's a smaller portfolio of loans, so there's not as many loans turning over on quite such a regular basis. As an investor, when you invest via our direct term investments, you are locked in for the term of that loan unless you choose to sell via the secondary market. So with the secondary market, you can literally click a couple of buttons against your investment, list it on the secondary market, and then other investors can effectively be matched to what you're looking to sell. It costs you nothing to use the secondary market, both as the seller of an investment and for the buyer of the investment. And the investments change hands at the same interest rates that the original investor had. So your way out early, Irene, from a home loan is to sell via the secondary market. So if you don't want to wait until the term of that loan has matured, you can list it on the secondary market and then other investors will match to it over a period of time. In the secondary market, we've seen kind of between 3 and 4 million a month starting to flow through that market over the last couple of months. So we've seen an increase in the amount of activity in the secondary market, which I think is a healthy sign and a sign that the marketplace is working well. For construction loans, it's taking, at the moment, I don't know, on average, less than 2 days. For home loans, we had one investor who sold quite a big chunk of home loans. It was stuck behind us for a little bit, and it took them a wee while to get sold. So that took them maybe 10 to 15 days from memory to sell what was a reasonable sized chunk of home loans. But typically, if you allow a 2-week period, based on normal market conditions and those sorts of things, then you can typically sell an investment within a couple of weeks. And the fact that there's no charge for that, I think, is a good thing for investors. Of course, past performance is no guarantee of what might happen in the future. If we go back to when the initial COVID lockdown happened back in March 2020, and if you recall at the time, share markets were tanking, everything was tanking, everything was bad news. No one knew what was going to happen, a lot of uncertainty. For investors that sold using Squirrel secondary market through that period, and that was personal loans only at that time, it took them anywhere from 1 to 5 weeks to sell during that period from memory. So even when the market was in a pretty shaky sort of place, everyone was still able to exit. Once again, there's no guarantee that that will take place, but secondary market is the way you can exit early. That was a very long answer to that one, Irene. Hopefully you managed to follow that, and feel free to follow that. Any other questions up with me on that front. First question is from Matt. Do we expect a recession and a fall in investors buying property will lead to a shortage of rentals and an increase in rent prices? Good question. Typically what we would see is all houses are effectively owned by someone, right? So if you're a developer and you've built some houses and you can't sell them, chances are what you'll do is you'll start renting them. So if you start renting them, that actually increases the supply of rental prices, of rental properties in the market. And if anything, you'll see rents start to reduce. There are some signs of that in Auckland. And I think if you look at if you're interested in renting apartments in Auckland, then the rents that they're generating are definitely lower than where they were 12 to 18 months ago. So I think, if anything, there could be an increase in the number of properties available for rent, particularly with the supply of new houses coming on board. However, we've seen rents generally go northwards in recent years. You get to some point where it just doesn't become sustainable anymore for landlords to keep jacking up prices. So hard to say exactly, Matt. I think we're probably in a balanced position at the moment where they'll neither go up nor down, particularly in the foreseeable future, which is probably about the next 3 days. So hopefully that was helpful, Matt. Moving on to the next question from Peter. Given the Reserve Bank's commitment to get inflation down to 2 to 3% by raising the OCR, inflation's unlikely to fall dramatically anytime soon, and the cold winds of a recession looking imminent, what would you be investing your money? Good question, Peter. I guess different investors will have different risk tolerance, right? If we look at what Squirrel offers, then home loans is the most conservative option, the least amount of credit risk. If you think back to those graphs and the data that I talked about earlier in the presentation, then the amount of credit risk in that home loan portfolio at 15 basis points currently is really low. We're reserving well north of that. The reserve fund's growing nicely. Lots of security on those loans, which is kind of the first line of defence. I think the LVR in that portfolio is around 65%, so lots of equity there. So that's the most conservative option. Construction loans, we've been quite picky and choosy with who we're lending to in that space. So I think credit quality will continue to be sound in that space. And then with personal loans, so while personal loans are the highest risk investment class that Squirrel offers, the reserve fund is really mature. I invest some money on behalf of my mum, who's beyond retirement age, and I have some of her money in the personal loans because the reserve fund is just in such a strong position that I don't see any risks of capital losses there, and I continue to see Squirrel's portfolio performing really well. So I think, Peter, really hard to answer that question in a general way, other than to talk about the amount of credit risk that each of the investment classes takes for Squirrel. Hopefully that helps. Feel free to ask a follow-up question. Okay, moving on to Glenn. Have there been any construction loans where the sunset clause has been exercised? Within the Squirrel portfolio, I'll make the assumption you're talking about the Squirrel loans that are in the Squirrel portfolio. To my knowledge, the answer is no. That doesn't mean to say it hasn't happened. There could have been some developers who have asked borrowers to extend. However, I'm not aware of any. So yeah, Glenn, I'm not sure I can give you a concrete answer on that, other than say I'm not aware of any. But there could easily have been some that have asked the buyers of those properties to extend their sale and purchase agreement. From what I'm aware of in the wider market, clearly sunset clauses have been used by developers often to try and exit a sale so they can sell the property at a higher price. It would be fair to say I've also seen borrowers who are exiting sunset clauses at present because they think they can then buy a property at a lower value based on the fact that property prices have fallen over the last 12 months. So sunset clauses aren't all one-way traffic. It tends to depend on which way prices are going in the market as to who's likely to benefit. I suspect developers will be a lot more cautious with how much time they give themselves in the foreseeable future. Thanks for that, Glenn. Question from David. Would one big default in the construction loan portfolio wipe out the reserve fund for that portfolio? I think the simple answer to that is that's highly unlikely to happen, David. So what gives me comfort that I can make a statement like that or deliver an opinion like that? The answer is the amount of equity that we have in the property. So when a loan draws down in that construction space, if progress payments are being made, we're only advancing value on that loan as there is value available in the property. So you have to see value created in order for us to basically lend on it. The equity position or the LVR position that we have in our construction loans on average is around between 60 and 65% in the portfolio today. So if a loan was to default, at that point, Squirrel would make an assessment of how that of the best way to exit that loan and generate the best return out of it. If it's a half-built house, chances are we'd look then to fund the remainder of that house build and then get it sold at the end. If there is already pre-sales on that particular house, or the house is already sold, we'd obviously look to try and exercise the right to sell that house to that borrower once it's built. And if it's a land bank, so there are some land bank loans in that portfolio. Typically, they have a house on them already, which is often rented and generating a return in that situation. So even if property prices have come back, as I've said, the average LVR in that portfolio is at 65%. So if house prices have fallen 20%, that still means there's 15% worth of equity in that loan at that point. So in the vast majority of situations, I would expect Squirrel would return the full value of that loan in a default situation back to investors. So there would be no loss in principal and no loss in returns. If a loan wasn't able to be fully paid back, the amount that it would chew into the reserve fund is likely to be in the 50 to 100,000 space. It's highly, highly unlikely to be in the 200 to 300,000 space. Could it happen? Who knows? If property prices fall another 20 to 30% from where they are today, then that may well be possible. However, we know those loans turn over relatively quickly, and we're reassessing our credit criteria and our credit appetite on a regular basis, which I mentioned or referenced earlier in the presentation tonight, saying that we made changes to our appetite in May this year and reduced the amount of risk that we were taking. So I think the simple answer is it's unlikely that it's highly unlikely that one loan could wipe out the whole of the reserve fund. It's more likely if a loan did end up with a capital loss that the reserve fund would easily be able to eat that up. And you'd be expecting a $50,000 or $100,000 loss, certainly not a $700,000 loss, which is the size of that reserve fund today. And that reserve fund growing at $40,000 each month as it stands right now. Thanks, David. Righto, moving on. Next question's from Nick. Given OCR recent 75 basis point rise and ANZ increasing loan rates today, and given loans exceed investor demand in construction loans, will the interest rate to investors in construction loans be increasing soon? Yeah, I just heard that ANZ increased their rates today. They gave them a decent nudge both on their floating rates and their fixed rates, and they've also increased some of their term deposit rates as well. I haven't gone and had a decent look at them yet, but I will be doing that over the coming days. Nick, we're actually reassessing our rates at the moment. I'd expect that we'll be making some sort of announcement around where our rates will move to over the next week or so. So keep an eye out. You'll get an email from us with the changes when they come through. I would expect you'll see an increase both in home loan and construction loan interest rates. And that may mean we adjust some of the personal loan rates along the way. So that's where we're at present. So under assessment, we're seeing what the market does and looking at where we think is appropriate to reset our rates to in the market at the moment. All right, thanks for that question, Nick. I'll move on to the next one. What happens if you've already invested funds and the interest rates change? All right, good question. And there's a bit of a convoluted answer for this, depending on which investment class you've gone into. So for home loans and construction loans, if interest rates change, the investment interest rates and the borrower interest rates are on variable rates or variable terms. So that means if we put interest rates up, let's say 0.5%, just for argument's sake, then all existing investments would shift up by that 0.5%. So if you're in home loans and construction loans, you're not going to miss out in that rising interest rate environment. Obviously, there's the flip side. So as interest rates fall on the other side of the cycle, then the returns would also fall, typically roughly tracking what might happen with the OCR. That's a really rough guide to it, but a guide nonetheless. For personal loans, they're a bit different. So our personal loans are on fixed rates, which means the borrower is on fixed terms and the investor is on fixed terms. So if we were to move interest rates upwards and you've already invested, let's say you've got a 5 to 7 year personal loan, which is at 7.5% today, then you would continue to earn that 7.5% return, even if the new interest rate on new loans for investors and borrowers was to go up. Okay. So the benefit of that is if you're investing for that 5 to 7 year period, you've locked in a return and you know what it's going to be. And you'd have to say 7.5% through the interest rate cycle is a pretty attractive return. The downside would be if you wanted to try and exit your loan over that period. So let's say interest rates have gone up to 8%, just for argument's sake. You want to exit your investment, which is locked in at 7.5%. When you sell on the secondary market, we have to advise investors who may be matched to that investment what the interest rate is, because they're taking it over on the terms that you signed up to. So the interest rate would be lower at 7.5%, and they would need to choose to accept or decline the offer that we've made to them. So what that typically means, because we do see this in the portfolio today, is that it can take a bit longer for your investments to sell on the secondary market. They typically all do sell, but where the interest rate's a bit lower, or there's been a credit event on the loan and we need to go and ask investors, then it can take a bit longer. Typically, it might take as long as a week, looking at recent history for personal loans. For home loans and construction loans, because all investments are at the same level as the prevailing rate in the market, then they just trade at face value. So there's no delay. We don't have to ask anyone for permission to match them against a particular investment. So yeah, two different parts of the portfolio: home loans and construction loans. If you've already invested, your interest rates will rise and fall as the interest rates move in the market. And for personal loans, a bit different. Because they're fixed rates, you'll find that that you're locked in for that term at that interest rate. The only real downside is that it can be a bit harder to sell through the secondary market. All righty. Thank you for that question. That was a good one. If there are no other questions, then I'll say thank you very much for joining us today. I really appreciate it. If you have feedback for me, feel free to send it to Dave at squirrel.co.nz. And then it'll come directly into my inbox and I'll pick up those questions or feedback or comments. So thanks very much for your time today. And there's no more questions come in, so we'll call it quits there. Thanks, team.